Welcome to our State of the Markets for the third quarter 2023. We're excited to have you join. You may be noticing a different format. Austin and I are going to be more dialogical in walking through these slides and less, hopefully, as just talking heads. So you can give us feedback on what you think, whether you like this one or a former type of doing that. You can see that this is July 14th, so we're about 2 weeks into the quarter. We have continued to see the stock market run up a little bit over the last couple of weeks, but the data that we'll use will be for June 30th. So as we dive in and ask what is going on in the markets right now, year to date, as we again think about those first two quarters, the U.S. stock market led the way up over 16%. Now, we'll talk a little bit later about the earnings of stocks because they haven't been quite that rosy and the reasons that we've seen the U.S. stock market respond as it has. But again, it's led the way up about 16%. International developed stocks are up over 10%. And then emerging market stocks have lagged only up about 5.5%. Austin, what are we seeing in the bond market?
Yeah, so what we see in the U.S. bond market, we're up at about 2.1%. And the global bond market is up about 3.6%. But a lot of that's going to be driven based on those interest rates that have risen in 2022. So bond investors are getting paid, though we got hit really hard in 2022 by those interest rate rising.
Yeah, and we even see that a little bit more in the global bond market where some of those interest rates during the course of this year have actually fallen back a little bit. So we get that seesaw effect where we have a yield that starts higher, that might be something like 4% per year, but then as global rates have dropped a little bit in some countries, we also see some price appreciation, which we really haven't seen in the U.S., but we have seen in international markets.
All right, so as we come back to the United States stock market, we look at the rolling 7-day average since 2010. And really what we're seeing is the market has come back up as you look at where we were in October of 2022 based on where we are today. We've seen a pretty good run up. Again, 2022 is not a great year for the stock market, but then in 2023, we've seen that value come back up. And what we're looking at here is the total stock market is indicated by the Wilshire 5000.
And as we see that, we're still about 10% from the high that we experienced in early January of 2022. So we've not fully recovered, but we have seen a really nice run. And the financial media, it's always interesting. They're going to try to find something to write articles about. And we've gone up more than 20% from the lowest point that we had, as you mentioned there in October, Austin, but we still haven't seen a full recovery. So a lot of things to kind of digest and think about.
So Spencer, let's look at the U.S. equity rates of return by category. So we're going to look at small cap versus large cap, and then value versus growth. So again, year to date, everything is up. We look at small caps up 8.1%. U.S. large cap up about 16.7%. So large cap has really, by and large, outpaced the small caps. Similar story with value and growth. We got up 5.1% for value, but large growth is up 29%.
Yeah, and it's interesting because a lot of these companies have done really, really well. Haven't seen a whole lot of movement in terms of their earnings, but there's a lot of hope that artificial intelligence will help companies drive profits forward. So you certainly haven't seen that. You look at the productivity numbers in the overall economy, and we're not seeing a big move in terms of increasing productivity based on something driven by AI. But the stock market is a forward-looking mechanism. So there's a lot of hope that those companies will be more profitable based on some of the things that have come out this year. To your point, small cap companies, those companies that are valued at less than $2 billion, haven't kept up with their large partners, or large counterparts, I should say. Those smaller companies are more sensitive to recessions, particularly in the United States. So there's folks that have been maybe hesitant to enter that market before seeing what might develop here over the next 12 months, people being a bit concerned that maybe a recession might emerge.
Yeah, as we look at it, the story is really the same in the international developed markets. We look at small cap up 5.5%, large cap up 11.3%, value up 8.9%, and international growth about 13.8%. So there's a little bit less of a gap in the international market, but large companies have still outpaced small. Growth has outpaced value.
Yeah, and it's one of those arenas that whether it's in the U.S. or international, again, there's that hope that those technology firms will be able to drive forward their profits at maybe a faster clip using some of the technology that they have. One of the things that we note here is that we don't have a deep dive on the emerging markets, in part because, as we mentioned to investors earlier this year, the emerging markets are composed of significant parts of them are composed of Chinese companies and Taiwanese companies. And so our focus has been kind of exiting that arena as we become more and more concerned with China as an autocracy and some of the belligerence that we've seen. So there's plenty of other places, thousands and thousands of stocks to invest in that are domiciled in the U.S., in Europe, in Japan, in other parts of Asia and Latin America. So let's turn over and look at kind of how we think about portfolio construction and where the market's at right now. The Vanguard Total Stock Market ETF gives us a flavor if we look at large versus small value to growth, that large growth area has become more and more the market. About a third of the value of companies would be described there. So we don't want to get out over our skis in that area. We don't want to have a lack of diversification. And so we appreciate a tilt back towards value companies and smaller companies, not, again, putting all of our eggs in any of those baskets. But again, you get a sense of what different ETFs look like. That one on the right is the total stock market that's just driven by the market capitalization of a particular stock. The one on the left has a bit of a tilt, again, back towards value and smaller companies, so that we get maybe a portfolio that is a little bit more well-rounded.
Okay, so Spencer, you touched on the earnings of companies. So what we're looking at here is the quarterly S&P 500 earnings per share. Everything in the blue line is actual. That comes up until March of 2023. Everything thereafter is estimated by the S&P 500. So help us understand this chart a little bit better. What's going on with the earnings with companies?
Yeah, so you can see tremendous growth in earnings. And if we go back even, say, to 2007, we had a peak in earnings in 2007. Earnings got hit really hard in the midst of the global financial crisis and then had some steady gains really up until 2017. And again, saw some pullbacks there in terms of earnings for a period of time, only to see earnings go up again. Now, we had the COVID lockdown that drove down earnings again a bit, but then they skyrocketed again in 2021. So peak earnings really there in late 2021, and we saw it last year that earnings kind of moderated and even slid a little bit. Now, they haven't grown as we've looked at the last couple of quarters in the way that the stock market has. So the stock market in the US is up 16%, but what the stock market again is doing is it's a forward-looking mechanism. It's not investing based on the earnings that were published, last month or last quarter. It's really looking and saying, what are our prospects here over the next couple of years? And you can see in the orange line that the analysts are fairly sanguine about what the next couple of years might look like in terms of earnings continuing to go forward. So they're projecting earnings growth that would push us back above kind of peak earnings that we saw a little over a year ago and push up fairly substantially here over the next couple of years. Now, what analysts don't do a great job of typically is accounting for a recession, because they look at things and they say, okay, well, what if the world looks about like it does today, but we're just advancing a quarter or a year or a couple of years? They don't really do as much of a job of analyzing, well, what happens in the midst of a recession? How is that going to cut into corporate profitability? So we have to take this with a grain of salt, because if we end up in a recession early next year, let's just say, then I think the estimates will be a little too rosy.
And that, as we talked about the growth of companies versus the earnings, what we can see here is the PE versus the 20-year average as we came into the year, quarter one, 2023, on the left side of the screen here. On the right side, we have where we're sitting today. So as you look at companies, we entered 2023, small companies were cheap, middle-sized companies were a little bit more expensive, still cheap compared to their 20-year average, and large companies were by and large still a little bit expensive. But you look at where we're at today, large companies are still expensive, but even some of those smaller companies have come back in line to their 20-year historic average. If we look at small growth, they're at 160% of their 20-year average. And so that really speaks to some of that price movement versus the earnings not keeping pace.
The small growth category is an interesting one because profits vary there widely. And there's a lot of volatility, a lot of ups and downs in the profitability of those small growth companies that's driving that. The thing that's a little bit more puzzlesome maybe is the large growth companies, because we've really seen a price movement of about 30%, but we haven't seen earnings move in the same fashion. If you look at the small value companies, for instance, we've seen a rate of return that's 2 or 3%, but we really haven't seen a movement in a change in that price to earnings category. Small value companies are still relatively cheap compared to their history, but then also particularly compared to other counterparts in size and growth there.
All right, so let's shift over to fixed income. So we're going to look a little bit more specifically in fixed income, just like we looked a little bit more specifically in equity. And so we look at the U.S. aggregate, again, up 2.1%. Long government bonds are up 3.7%. U.S. high yield is up 5.4%. Those shorter term bonds for the U.S. government are 2.3%. Then as we look at catastrophe bonds, and this is measured by the Swiss Re Catastrophe Bond Index, they're up about 10.3% year to date.
Yeah, it's interesting. We look at the bond arenas, and with yields being a lot higher that we talked about, investors, their base case return is going to be at a stronger point. Now, the U.S. long government bonds have had a little bit of a tailwind because those 30-year bonds, the yields came down just a little bit over the first 6 months of the year. So you get 2 or 2.25% as the interest income, and then you get a little bit of price appreciation because interest rates in that arena came down just a touch. You don't get that same thing when we look at the U.S. aggregate or U.S. government short index there. You basically are just looking at the yield in those circumstances that's just a little over 2%. Now, the catastrophe bonds are interesting in that that Swiss Re index would suggest that you're getting a rate of return that's really driven in two areas. One would be the fact that in the reinsurance space, premiums are really high compared to where they were just a few years ago. We've seen natural disasters like hurricanes or wildfires or other things, and that's driven up the price of insurance, which has driven up the yield on those bonds, which is one driver of the performance. The other thing is the collateral investment there is in short-term U.S. government bonds. So when the yields are much higher there, then we also have a tailwind there. So catastrophe bonds have done quite well over the first 6 months of this year, and really coming into 2023. One of the reasons that we were looking a lot at diversifying across reinsurance like catastrophe bonds, looking at alternative lending and direct lending, is we wanted to have other places that would have different rates of return than just, say, U.S. stocks and U.S. bonds.
Yeah, so to go off of what you were saying about that interest rate movement, if we look in the blue line, that's where U.S. interest rates were sitting at June 30th of this year. The gray line here is December 30th, of 2022. So we look out here at the long end, and in December, the yield was 4%, and then at June 30th, it was 3.9. So again, we've seen those rates kind of dropping, whereas on the shorter side, we're seeing those interest rates rise. We've gone from 4.4% in December to about 5.4% at the end of June.
And it's a great illustration of what happens in that seesaw effect that we talk about. The farther you are out on that maturity spectrum, the more that a movement in interest rates impacts your investment. So if we look at the 3-month part of the curve, we went from 4.4 to 5.4%. Well, we didn't see a loss in the value of those bonds, because if you bought it, December 31st and you held it, then you held it to maturity, and it matured in March, and then you just reinvest those funds. So you would have seen 2 cycles or 2 full bonds come to maturity there. On the 30-year side of things, well, now we're way out on the seesaw, and so just a little bit of a movement there in the scale would mean that you feel it a lot more out at the end of the seesaw. So a 0.1% drop in the interest rate pushes the other side up about 1.5% in terms of the price, and that's why we saw those bonds move up. They were up, I think, 3.7% overall. So it was a substantial move in price, even though it was a very, very modest move in terms of the interest rates. And here we really see what's happened over time with respect to the current yield versus what we've seen historically over the last 10 years. Last 10 years, interest rates have been pretty low. If you look at the gray part of the bar chart there, you can see that that's the 10-year median. So in each case, whether it's U.S. Treasuries, that would be government bonds that are backed by the full faith and credit of the U.S. government. If we look at the history, it would be, again, the gray. If we look at right now in the dark blue, that's where we sit. So we're almost, we're well over double the yield. If we look at the investment grade corporates, these would be those corporations that the rating agencies deems having a high credit worthiness. They're investment grade. You can see that we're a couple percentage points higher, and the same thing really in the municipal space. Higher yields, that's defined as the yield to worst across those sectors there. So in each one of those areas, to your point, Austin, investors are getting paid much better than they were at the beginning of the year, or certainly a year and a half ago.
We showed this chart in our January State of the Markets update, and what we're looking at is asset class valuations based on a Z-score. So what the Z-score does is it says 0 is your 20-year average. If you're above, you're higher than your 20-year average, and if you're below your 20-year average. And the numbers are standard deviations away from the mean. So we look at U.S. core bonds, and they enter the year negative 1.17. So that's 1.17 standard deviations below their mean. So they were cheap compared to their 20-year average. They are sitting now at the end of quarter 2 at 0.65 standard deviations below their 20-year average. So again, still cheap, but not as cheap as they were entering the year. And we look on the opposite side at U.S. growth. Again, U.S. growth came into the year a little bit expensive, about a half a standard deviation over their average, but now they're about 1 standard deviation over their average. And so we can see where those price movements have come and how those asset classes have different values now based on where the movement has been this year.
And it's interesting because, for so long, clients got probably tired of us saying, asset classes, it's the mediocre, the bad, the ugly. Stocks are mediocre. They are priced not inexpensively. Bonds are expensive, but they're not terrible. And cash is just ugly because it's not paying us anything. We came into this year saying, well, actually, if you look at the blue bars there, or you look at the gray bars there, I should say, bonds are fairly cheap compared to history. Stocks, even in many arenas, are fairly cheap compared to history, and cash is actually paying us. So it was a different viewpoint, but we fast forward again 6 months to where we sit right now, and particularly large growth companies, because they've shot up 16% or more. I guess larger growth companies actually have shot up 29%, I should say. But the overall U.S. stock market up 16%. We find that they're not cheap anymore. They're actually about 1 standard deviation expensive in those U.S. growth equity side of things. So what do you see in the international space and then municipal bonds and small cap there, Austin?
So with international equities, what we're seeing is, again, we came into the year cheap. We're still 6 months in, about half a standard deviation cheaper than their 20-year average. So there has been movement, but we haven't seen the movement as substantially as we have in the US markets. Similar with municipal bonds, they started the year a lot cheaper than they have been historically, but they're kind of starting to come back into those 20-year averages. We're still a third of a standard deviation below their average, but we're seeing that movement back towards what that 20-year average is. All right, so Spencer, we're going to shift from stocks and bonds over just to general economic indicators. So we're moving this conversation towards, are we in a recession?
Yeah, and we go back, and there's a lot of different ways that people think about recessions. The actual national arbiter for deciding whether we are in a recession is the National Bureau of Economic Research there, the NBER. But it's really just a term to try to help us wrap our minds around, are we seeing the economy continue to grow, or is it contracting just a little bit? One of the ways that we can think about how healthy is our economy is the unemployment rate, and we have it here back to 1970, so we've got over 50 years of data there. What are we seeing in the unemployment rate here recently, Austin?
Yeah, so recently, we saw the spike for COVID where unemployment jumped up to 11%, but then you see almost just as dramatic of a drop in the unemployment rate. So unemployment bottomed out in the fourth quarter of 2022, and we've seen it come back up slightly, but it's not been a really big movement. We're seeing from 3.5% unemployment to 3.6% unemployment. Our 50-year low here, you can see, is 3.5. Our 50-year average is 6.1%. So we're still below our 50-year average.
Yeah, so as we look at it right now, it still seems like everything's clicking in terms of the economy moving us forward in growing. Now, we don't have a population that continues to grow. We've talked about this in the past, but there's two ways really that we see growth in economic output. One is that we have more people in the workforce, and another is that our people are more productive. And so productivity, we've seen some gains, modest gains here of late, but we're not really seeing a growing workforce. Now, the good news is that we're not seeing a workforce declining at the same rate that, say, we see in Japan or in Italy or some of these countries that have very low birth rates and very low growth overall. But we are just grappling with the reality that even if we see very, very low unemployment, we may not see huge gains in terms of economic output because our workforce isn't growing in the same way that it was, say, in the 80s and 90s.
And we can really see that in non-farm employees exiting the workforce. So the dark blue line, what you're looking at is employees that are voluntarily leaving, they're quitting, versus the light blue line is employer layoffs. And so there's a really big spread here between employees quitting versus layoffs. So it's over the last 23 years, but those spreads have been pretty thin up until recently, where there is a pretty big spread between employees choosing to leave the workforce versus employees being laid off.
And we see the one reversal, of course, there was in the midst of the COVID lockdown. You had a lot of companies that were laying people off, so there were very, very high levels of layoff. But that's come back in the opposite direction. I think the thing that, as much as anything, is interesting is the quits current versus the 20-year average are really high. So that just kind of would indicate that people think, okay, I can quit and I can find other work, or maybe I've already found other work and I've renegotiated with, I've got a couple of firms that want my services, and so I can negotiate, higher wages or better employment terms or whatever it might be. When you see that level of quits relative to the long-term average, it would indicate that, again, the employees have some leverage there, and that the economy, if not clicking on all cylinders, at least employers are really trying to find people for work.
Yeah, so next we want to move into looking at one of our favorite indicators, the CPIW. So again, if you're unfamiliar, the CPIW is what the consumer price index is that measures urban wage earners, and clerical workers. So this is what the Social Security Bureau uses to determine what that cost of living adjustment is. So we look at it, and we've seen inflation rose pretty substantially coming from the second quarter of 2020 all the way up where we saw in second quarter of 2022, CPIW ended that quarter at 9.3%. So we're dropping back down. Right now we're at about 3.5%. But as we've talked about this, Spencer, inflation isn't just magically going away. All the prices that we have seen increases, they're still continuing to increase. So it's not that we're seeing a deflationary period, but we're still seeing inflation. We're still seeing prices grow. They're just not growing as fast.
And I think that's such an important thing to walk through, even in an example. We've talked about this with vehicles, and in one of the inflation-focused presentations that we did, talked about what inflation was for new car purchases and then also for those used car purchases. But it was well north of 20%. Was it almost 30%, I think, at one point? So can you walk us through kind of, let's just say we've got a car that we purchase, and to make the math straightforward, let's say that we purchase a vehicle, and in 2020 it's $30,000 for a new car. We see 30% inflation, and then on top of that, maybe the next year we see, instead of 30% inflation, we see 3% inflation. What would be those prices as we go up there, Austin?
Yeah, so you think $30,000 car, if you've got 30% inflation, that price of the car is going to jump 30%. So that car price is jumping $9,000. So the car that you bought in 2020 for $30,000 jumps to $39,000. Now, what the media may want you to think is that inflation is slowing down, which may cause you to think that means prices are going down. That's not what that means. The car is still going to be sold not at $39,000. It's going to get a 3% jump. So it's going to be sold a little bit over $40,000. So you're not seeing prices return to that 2020 level. Your car is not going from 39 back to 30. Your car is going to continue to get more expensive.
Right. So we go a little bit north of $40,000, but at least we didn't go to $48,000 or $49,000. I guess that's the only silver lining here, is that we didn't do 30% as another jump in the midst of that.
Yeah. And there are places where we are seeing deflationary pressures, but by and large, again, you look at this entirety of the CPIW, we're up 3.4% year over year. So while you may see prices drop in some areas, across the board is where we're seeing the inflation.
Well, and hopefully we see price of eggs, come back to earth, instead of being $12 a dozen or something outrageous like that. So I think it's important to note that there are some particular areas where, whether it's because of illness of animals or supply chain elements, that maybe those prices do come back a little bit, but most of the economy we continue to see just a little bit of a step up in different areas. So we've talked about what's happened with inflation. We had higher inflation because we printed a lot of money to deal with the COVID lockdown, and then we've seen inflation moderate some. What's kind of the expectation set that different people and institutions have going forward, Austin?
So the two lines that we're seeing here, the dark blue is break-even inflation, which is the difference between a U.S. Treasury and a U.S. TIPS, a Treasury inflation protected security. And so really what we're seeing is, what does the market, as we're looking forward, what's the next 5 years of inflation expectation? And so the break-even, that 5-year looking forward of U.S. Treasuries versus TIPS, is about a 2.2%. So that means the forward-looking expectation is that inflation is going to come back down to about that 2% mark. That's kind of what the market is looking into. Whereas consumers, we are anticipating that inflation is going to be running higher at about that 3% rate over the next 5 years.
Right, and we've got a couple different ways that that's calculated. I mean, the University of Michigan does these surveys, and that's how we come up with that gray line number, the consumer expectation number. and whereas the market really prices that in, and it's easy to be able to track that because you just back out the math on tips versus treasury bonds in terms of the yield.
All right, so Spencer, are we in a recession? Is a recession looming? Answer me, we need to know.
Well, and one of the ways that we want to come back to even responding to this question is there is much ado made about this particular word, recession. If we look at the long history of the developed world, our economy continues to grow and produce a little bit more on average each year over time. There are going to be some ups and downs. There's going to be some years where maybe our economic growth is 3 or 4%, 5%. Some years where our economic growth may even be negative by 1 or 2%. But oftentimes the financial media will show charts where it looks as though the economy just fell off a cliff. Even in the midst of the global financial crisis, the worst downturn in decades and decades, we saw a drop of about 4% in terms of economic output. Now we did, of course, in the midst of the COVID lockdown, we saw a little bit more, but the bounce back was very, very quick there, whereas the global financial crisis, it took a little bit longer to kind of sort through all those different pieces. But this was not a situation where the U.S. economic output was halved, or we lost, 25%, like what we might have seen in a period like the Great Depression or something like that, where we see a much bigger drop in overall economic output. We want to even just frame this conversation about recession and say, well, sometimes just based on the metrics and how we measure things, we're not growing at quite the same pace, but it does not mean that the sky is falling. It does not mean that companies are not very, very profitable. It doesn't mean that we need to, bail out of a long-term investment plan. So we'll get to these different pieces, but as we frame this, what we want to look at are a number of different indicators, actually, that the National Bureau of Economic Research uses to define what a recession is. But even as we look at these, we'll go back and we'll look at when the NBER declared a recession in 2010, looking back to 2009 and the period prior. But it was just bizarre, to think that we should really put too much stock in it, because everybody knew that we were going through a difficult time economically. But by the time we had declared that we were going through a difficult time economically and used the word recession, we were already, the stock market had already responded and bounced back. So can you walk us through these different indicators? This is one of my favorite charts because we got a lot of things going on here. So we get to talk about, these 6 different data points that the NBER uses and go back over 20 years. So Austin, what is this telling us here?
Yeah, I'll walk us through this as best as I can, because you guys know that I love chaotic charts. So essentially the NBER looks at these 6 indicators. It's the household survey of employment, industrial production, non-farm payroll employment, real personal consumption expenditures, real personal income less transfers, and real wholesale plus retail sales. So the NBER looks at these 6 and they say, for a recession to be called, are these in a negative period? Is a year over year? Are they trending downward for multiple months at a time? So they look at these every single month and say, okay, are they all negative? How long are they negative? So you can see there's periods where some of them are negative, but not others. So we see in 2015 and 16, industrial production was negative, but the rest of them were positive. So that's why we don't see a recession being called in 2015, 2016. Whereas in 2020, the COVID lockdown, it was very brief, but the breadth of it was very deep. So what we're going to do now is, instead of just looking at this chaotically, we're going to clean this up a little bit. So what we've done here is we've taken a blended average. We've added all the indicators together and then divided by 6. And so what this really shows is where we've moved over time with these indicators. And again, this is what the NBER is looking to determine whether we are in a recession. Spencer, a couple of weeks ago, I looked at seeing just what does the NBER, when do they determine a recession? And like you were saying, the great financial crisis of 2007, 2008, 2009, it was not declared that that was a recession until 2010. And not even early 2010. It was, I think, September of 2010. So we have already passed through a lot of that drop, the feeling, the pain, before the NBER even determines and says, yes, we were in a recession. And going back to your point, people knew it, they felt it, they lived through it. But sometimes these indicators, because you're waiting for a year-over-year change, you're waiting for those measures because they're lagging. If you're always waiting for someone to declare a recession, the recession may have already passed you.
Sometimes we'll sit down and as we talk with folks who will say, well, I'm not going to make an investment until I know that there's not a recession. This is kind of, if we use these indicators, it's akin to driving through the rear view mirror. You're going to get some level of data, if you look just solely at the rear view mirror, but you're not going to avoid significant traffic events, wrecks, if you're driving through the rear view mirror, because you have all of that in front of you and to the side that you've really got to take in and digest. So what we want to do, rather than doing that, is just recognize that there's going to be some recessions over time. Again, does that mean that Walmart is going to go under or that they're not going to make money? Probably not. It would take a Armageddon type of situation probably for Walmart not to make some money, or Apple for that matter, or other types of companies that are these massive global companies that have all kinds of different income streams. But it does mean that they might make a little bit less. And if they make a little bit less, then investors, some of them might become concerned and might run for the exit. So that's what creates volatility, is when folks are not really looking at that long-term investment. Like Warren Buffett likes to say, the ideal holding period for a stock is forever. We want to look and see that long-term approach, because every company is going to miss at some point on their quarterly earnings. Every company is going to go through a rough patch. But we want to be invested with a long-term approach in mind.
And so with that, what we're going to do next is we're going to look at a couple of hypothetical situations about what would happen if you were a dollar cost average investor. So you're investing $1,000 a month, every month, since the year 2000. And so again, these situations are hypothetical. We are going to be using the Wilshire 5000 total stock market index. So just saying, can't invest in indexes, but if you invested $1,000 in that index over this period of time, what's going to happen? And so we look and we say, okay, January of 2000, your value is $1,000 because you've only invested $1,000. And as we can see, that line moves where we would want it to move, where it's moving up and to the right. You're seeing the growth of your investment go. And where we're ending today, if you were, again, invested in the Wilshire 5000, the total U.S. stock market, you're ending at about $1 million, a little bit over $1 million. So you've seen a pretty good growth over time. Now, again, you're continuing to invest. You're not getting out when 2008 happens. You're not getting out when COVID hits. You're not getting out in 2022. You're just staying the course. So next, what we're going to do is we're going to contrast that investor with an investor who got scared in 2007 and went entirely to cash, and they never re-entered the stock market. So Spencer, you want to walk us through this one?
Yeah, so this is an interesting one because we're basically profiling somebody that got it right, okay, in market timing. Now, to really do well in market timing, you need to make two decisions right, and we'll talk about that a little bit more. But this person recognized that maybe there were some issues in the global economy, and they actually sold out in towards the peak in 2007, but then they just said, I've seen the volatility. I saw the stock market maybe go down 57% from 2007 to 2009 early. I want to be very secure in my investments. So they invest in cash there. So you can see there's a growth in that orange line up until 2007. It's a little bit steeper, but then from there, they're just investing in cash. They're investing in 30-day treasuries, and so they're getting a rate of return. It's just much more modest. So at the end of that, if you want to show the values there, Austin, on the chart, we still would, of course, would have $1 million north of that in the stock investment that is just a dollar cost averaging across U.S. stocks if there's no frictions and you got a rate of return that was driven by, again, the index, versus if you made the right decision from a standpoint of you missed the downturn there in the global financial crisis, but went to cash, you've only got about a third of the value there, just north of $360,000. So missed out on a tremendous amount of the upside and haven't had the volatility, of course, that goes along with that over the last 15 years and change. So that would be if you sold out, before the global financial crisis. We'll look at this next one, and as we get there, we'll look at selling out right before the COVID lockdown. So this would be even more difficult to predict because, prior to 2019, nobody had ever heard of COVID. So this would be suggesting that you could sell out in February 2020, right before the COVID lockdown happens. You could see if you did that, you missed that downturn, that stocks dropped by about a third in the course of 30 days in the United States. So you missed that big drop, but you also missed the recovery on the high side of things. So if we did that, you can see, and of course you can see that purple line bends upward just a little bit more significantly towards the end because we are seeing interest rates increase, and so we're seeing a bit of a return there, but not like with stocks. So in this set of circumstances, again, we've got over $1 million with just investing in that dollar cost averaging approach. In this one, even with the drop that we saw in 2022, we still have a much higher portfolio value just with stocks than we do with the having missed that COVID drop. So, if we got out right before that COVID lockdown, we have less than $800,000. So even just over a couple of years, we've missed a significant amount of run-up. So that's why we always come back to the financial planning side of things and say, we don't know where the stock market or bond market might go in a particular year. Last year was a rough year for stocks and bonds. As we talked about in January, the worst year for bond market performance in the United States history. Even with that, on the stock side of things, a drop of about 20% last year in the U.S. total stock market. Even with that, you can see that long-term average has been a nice driver of returns, and we don't want to interrupt that compounding, that happens. We don't want to try to time getting in and out. We like to say that time in the stock market historically has protected us. Timing the stock market has not protected us over time, because we have to grapple with the fact that we also have some inflation to contend with over time, and stocks have been a nice offset. So Austin, you want to tie this up just with both of those pieces?
Yeah, so again, if we look at this all together, obviously if you are that dollar cost averaging investor, you're staying the course, you're ended up higher at the end of the day. Now, were there periods where you were lower? Yeah. We look back at the orange line, and from about October 2007 through early 2012, you're ahead, you've done well. But ever since then, you're behind. Similarly with that COVID lockdown, it's from January to June, you did well, but then you got outpaced. And we've talked about this in other videos before, but that dollar cost averaging, where it really shines is if you're continuing to put that same dollar value in. If the market drops 20, 30, 40%, then that $1,000 that you were buying, you're buying more shares so that you're continuing to see that growth, but with more shares that you've invested with the same dollar value. So that's why we really think it's important to not try to time markets, to not try to get in and get out, because a lot of studies just show that it's almost impossible to time the market with any sort of frequency. And so we say, continue the path. If you have questions about continuing the path, if you have fears about continuing the path, we want to talk to you about that. We want to try to walk with you through that, because it's really important to stay the course.
Yeah, and we've seen that, here a couple of times illustrated in the U.S. stock market, but we see that really with global stocks and with other types of investments there too. We've got to get in a posture where we're prepared to stay the course, because we're not investing just in these lines that go up and down. We want to come back to this idea that it's not just something that, CNBC or Fox Business or whoever, you look at in terms of a business media reporting institution, the Wall Street Journal or others. It's not just some number that they're publishing, that is the stock market. This is an amalgamation of the performance of U.S. companies, large U.S. companies. So, when we think about it that way and we say, okay, we're going to invest in thousands of companies, we're going to be small owners in thousands of different companies, that tends to help ground us a little bit more than just saying, okay, well, I'm investing in, who knows, the stock market, that number went up or down. Well, this is, think about it as, again, is Walmart, are they likely to go out of business or sell fewer goods or services? Same thing with any of the other companies that are out there. You're going to have some that have a tough time from time to time. But the overall economy, again, the overall market is driven by what thousands of companies are doing there. So we want to come back to that as an anchoring point. As always, if you have any questions, don't hesitate to reach out. We remind you that past performance doesn't indicate future results. Indices are unmanaged and cannot be invested into directly. And with that, we'll say thanks for joining us, and we'll sign off and see you next time.
If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.